So what can I say about energy risk management, or risk management in general? I've got a few slides here. I'm going to kind of just pick through them randomly because I've kind of changed my thinking a little bit after hearing Amy's and Glen's conversation. So first of all, what is driving the growth and need for risk management and energy? Let's take a step back and just think about risk management as a discipline, a formal discipline. It's relatively immature in that it's, as a formal process, it's probably only been around for like 15, 20 years. And it really kind of started in the banking industry for obvious reasons. That led to sort of deficiencies in that process led to the credit crisis, which we've all heard about. And it's become a much more formalized and disciplined process. Energy risk management, for a number of reasons, has grown in importance. Some of which have been discussed today by Amy and Glen. But if you think about their combined presentations, you've got the fundamental analysis of sort of the geopolitical outlook for energy prices and commodity markets in general. And you've also got this interrelationship between physical and financial assets that is becoming more and more complex. And Glen, being the data guy that he is, data sets in general are becoming much more complex and robust. So there is that need to develop that, a formalized process, and it really is. Risk management is really a formalized process for thinking about the various factors that can affect one's business. And if you think about risk management on a fairly basic level, you've got three broad categories: market, credit, and operational. So market risk is what are the factors that are going to impact my business and the potential value of my production, for example, and what do I do about that, if anything. Credit risk can take two forms. You've got straight lending, which I'm sure you're all familiar with. Am I going to get paid back? And what's my protection if not? And then counterparty risk. When you enter a financial contract, there's typically counterparty risk on both sides, which, depending on the underlying product, can have severe volatility. And then, of course, there's the operational end of the energy business. What do I do if my plants aren't operating? What's the economic impact of that? And have I developed a safety culture that's going to protect human life at the end of the day? So just stepping through, there was a question this morning about risk management with respect to the geopolitical risk today. Again, risk management, there is no silver bullet for what to do in those instances or in the risk management process. What you're really trying to do in the risk management space is think about your potential exposure, potential outcomes, and it's really a probability function. You're trying to protect against the tail risk at the end here, the 5% probability that you're going to lose a bunch of money on a high impact, low frequency event. The thing about energy, this slide's a little misleading in that we're using a normal distribution. As we know, energy prices price returns are not typically a normal distribution. You've got kurtosis and skew that kind of changes things up. But for simplicity, all I'm trying to demonstrate here is that you need to develop a probability distribution of what your expected outcomes would be. So boiling that down a little further, there are a couple of tools that you can use. Value at risk. VAR, I don't know if anybody's familiar with the VAR model. Its origins are in the banking sector. It's been adopted in the energy space. It may not be the most effective tool for energy companies just because of the nature of the underlying assets. But it does give you some sense of what your potential exposure could be over a defined period of time at some defined confidence interval. A more qualitative approach and what might be more appropriate for the energy space is stress testing and sensitivity analysis, where you build scenarios. What's going to happen to the price of oil given some geopolitical event. You put probabilities against that, and you develop outcomes based on it. I think the combination of the two is really the most effective approach, and they kind of work hand in hand. This gets back to counterparty risk. This basically outlines or illustrates the number of permutations price paths a derivative contract could take based on outcomes, and you could be at the higher or lower end of this, the winner or the loser, if you will, and somebody's got potential exposure on the outcome. So again, we're getting back to probabilities of outcomes, and that's sort of general theme with respect to risk management. And as we've seen over the last several years, and even dating back to the 70s, human error, operational risk with respect to complex systems that you find in the energy space is a real issue that needs to be addressed. That again, sort of a theme throughout this little discussion, is that risk management is a process. You need to put systems in place to sort of button things up and make sure, these sort of events don't happen. So at GARP, Tina alluded to the ERP program, and we have what's called the Financial Risk Manager Certification Program. These are certifications that folks can take to demonstrate and sort of demonstrate that they have the skills necessary to be, a risk manager in the space. And with these programs, we typically do a survey of risk managers to find out what are the key tasks, skills, knowledge, and abilities that folks need to effectively do their jobs as risk managers. And this is sort of just some outcomes from those surveys. In this case, we're looking at what are some of the top 10, or what are the top 10 risk management tasks. And if you go through the list, the interesting thing that comes to mind here, or is indicated, is that communication is really the key. And again, getting back to the process, you got to be able to effectively communicate what your exposures are, what your risk factors are throughout the organization, and how, and you just be aware of them all. VAR, as I said, is a good quantitative tool to sort of develop that potential exposure, and it's highly rated on this survey. It's a calculation of probability of default, expected loss given default, some of the credit risk metrics are all important. And then regulatory capital. The banking sector and the energy sector are both very highly regulated industries. Being aware of the regulatory impact on your business is obviously a very important component of the risk process. I'll just kind of skip through this. This sort of just identify some of the basic skill sets that are necessary in the risk space. And again, just building an effective risk management process requires a high level of support. Comes from the board of directors down through senior management. It's got to be an integrated approach. Everybody's got to be on the same page. You can't really have silos within the organization doing one thing, sort of that may be counterproductive to other groups in the business. Everyone's got to be in the loop, and risk education is important for everyone. And with that, I'd like to just open it up to discussion, Q&A. I think that's probably a better way to sort of address some of these issues.
Perhaps we can kick off the Q&A by going back and addressing some of these polling questions, and then open it up to the audience. See if I can find this. Oh, I guess the results are gone.
No, go full screen.
Pardon? Shift it now? Okay, well, the first question was, U.S. oil and gas producers are required to revalue reserves biannually for reporting purposes. What is the cumulative 2015 write-down of oil and gas reserves reported by a group of 66 producers through the end of 2015, excuse me. The most popular answer was, by 44%, was 51 to 60 billion. The next most popular was, by 24%, 61 to 70, and then 20%, 30 to 40 billion. So what do you guys think about that?
Are these live? The mic? Okay, well, I'll go ahead and say that the danger of this question, she's actually wrong about it because it's a fact. I've been doing a quick back of the envelope, and a very primitive one was going to go to the high end of that. I have no idea if it's right or not. I think it was your question.
Yeah. So this was actually reported in the journal sometime. I think it was in late August, but the answer is like just under 60 billion in write-offs. revaluation that they go through. Just under 60 billion. So answer C is the correct answer. So that's 44%. Nice job.
Very good.
And I think the takeaway from this, from a risk perspective, is again the importance of stress testing. I mean, building in scenarios and trying to kind of get a sense of where your risk is within the organization and your positions. And another perspective.
I guess what I would say, linking that statistic to sort of the end of my talk, I did a paper that's in energy economics with some other faculty at Davis and at University of Otago. And we did a, I'm sorry, I'm jet lagged or the Middle East. It'll come to me in a second, what the kind of analysis. We did basically the analysis where you look at how the markets reacted to news events over a 3-day window. And we went back and looked at sorry?
Event study.
We did an event study. Thank you. Thank you, it's been a long day. We went back and did an event study of this idea of the carbon bubble, right? So are the markets responding to news about the possibility that oil and gas or coal companies have too high a valuation because we're going to have a climate agreement at some point in history, or carbon is going to get increasingly constrained in different key markets, and therefore these companies have too many assets on the books that will turn out to be quote unquote unburnable. And we found this very interesting result. We decided it was a great thing to do an event study for if you're academics, because if the market hasn't recognized the risk, then you have a paper. And if the markets recognize the risk, you have a paper, right? So not being, on Wall Street, it was a win-win. So we did it, and the study showed really interesting thing. What it showed was that the market actually did respond to science. In 2009, when the first set of science papers came out, Munchausen, et cetera, and a few other papers, that actually, we only looked at the oil companies, we didn't do coal, but it showed that the 63 largest oil and gas upstream firms, those firms that are either highly integrated like Exxon but have a big upstream or only upstream, lost $23 billion in market cap that we were able to identify coming from that event, as opposed to a related event, which was the Australian carbon tax coming on, which was an additional a loss of value. So in total, $27 billion of market caps, about 3% of market cap was shed. But then subsequent things like Al Gore's, op-ed in the Wall Street Journal and carbon tracker studies and things like that, and even banking, the HBSC study did not actually have a significant impact. But it opened the idea that it's not zero. In other words, people are not so skeptical of the concept that the impact was zero. So the thing that I think is sort of interesting about these write-downs is, to the extent, like yesterday, Shell announced a write-down of $2 billion by canceling some oil sands projects. So to the extent that the market starts to anticipate that there's either going to be write-downs in certain kinds of assets, or you can kind of see it happening already in the coal industry, that certain locations and mining operations for coal have already basically been written down. And Glenn mentioned this thing that corporations turning to the bond market. So if you were a bondholder of at least some of the U.S. coal companies and some of the other coal companies, those bonds are now illiquid. And so what I see coming forward, which is I think a real challenge for the energy market, is we might get to a place where people do the risk analysis, decide that the risk to certain kinds of fossil assets are higher than others, and then those assets may get decapitalized before we actually stop using them. And that, I believe, is going to be a problem, especially in coal, where you're going to actually need the coal because 40% of electricity in the United States and X% in India and China are going to be based on coal. And yet, who in the capital markets is going to fund that? And so there's some presumption, looking at these early things in Latin America, and even rumors about how the US different PUCs is going to handle it, that you're actually going to find that public finance is going to have to come in to these markets because the private sector is going to be reluctant to take on the risk.
Yeah, that topic came up with nuke funding yesterday too in one of the sessions.
Well, thank you. The next question was, global energy consumption dropped in the aftermath of the credit crisis in light of the current global economic turbulence. What is the probability that we witness a drop in world energy consumption sometime in the next 2 years? The winner by 67% was option A, less than 5%.
Well, I identified Michael's the other question. This was mine, and I'm in the tail at the upper end. That's because I think there's another shoe to drop with the economy globally. But you know, I'm also in the high volatility camp, given the absence of predictive power. So you could easily imagine other outcomes.
So I was going to elaborate. I very much really enjoyed Michael's talk, and I was particularly interested in his last bullet point about the declining liquidity for people who want to invest in infrastructure. And that is beyond what I just said about the whole carbon aspect of that. And there's an additional issue that I see coming that I'm now citing the work of my co-author. So I wrote a book with a Rice professor, econometrician named Mahmoud Al-Gamal. And he has done a new tranche of work that's super interesting. And here is his thesis. So you all might remember our original thesis was that part of the asset bubble momentum that we saw from 2006 into 2014 or 2013 came from adding the sovereign wealth surpluses coming from the oil revenue surge, because that money can't be absorbed very well in Saudi Arabia and other economies, and so it comes back into the international circuit as hot money. And even though you already had Chinese hot money, you know, Mahmoud's analysis was sort of that when you added this Gulf hot money on top of the Chinese money, that's when you really started to get bubbles. And then, of course, it became such a severe bubble that it popped. So now Mahmoud has this fantastic set of slides where he's saying the opposite is happening. Because the oil prices are so low, and because the major producers, Saudi Arabia, UAE, Qatar, and the Russians are in a war, they're spending all their capital, which is much less than it was before, on military equipment. And because they're spending 10% of GDP, in the case of Saudi Arabia, on military expenditure, they don't have I was just out in the Gulf. What people are actually doing is the sovereign wealth funds are selling assets to finance these wars. And because they're selling assets to finance the war, people have not recognized yet that there's no liquidity for these assets. And so what you're going to get is this possible liquidity crisis that will expand past project finance and into what we call real assets, right? And so you could have a bigger liquidity crisis that would bring down the value of assets, which would destroy real wealth, which would therefore cause a second recession. So that's kind of negative. So that's why I also was outside the majority here, knowing that risk still exists. The tail risk. I saw that tail risk.
Thank you. The next question, currently non-hydro renewables provide under 3% of total global energy usage. What will this percentage be in 2025? Winner, 6 to 10%, which was gained a 44% majority vote.
Is there a mic out there for the audience? There would be another way to proceed.
Any comments?
I guess my comment would be that in the United States, because we have been seeing falling electricity demand, there's some question about whether, well, I mean, I can't remember whose slide it was, I guess it was Michael's slide, we're seeing a bit of a shakeout in the valuation of the solar companies, right? In addition to that, in China, I just saw a presentation on China, and Chinese electricity demand is flat this year. So that's also, even though the Chinese have a really ambitious target for solar and wind, it's coming against a flat curve for demand for electricity in general.
Did it change?
Next question, what year do you think electric vehicles will reach 10 million on the road globally? The winner was B, 2030.
It does look like a small. I heard someone in the audience ask the question what the current number is. I don't know the answer to that.
So just to give you guys, again, a perspective on coming from California. So the number in California, if I'm not mistaken, it's like, I've got jet lag, but so don't quote me. Nobody tweet this because it might be wrong. I think it's only 100,000 vehicles, right? It might be 300,000 vehicles, but the point is, it's in the low hundreds of thousands. I think that the state of California is not having as easy a time getting consumers to pick these vehicles as was expected. China has a very ambitious target of 5 million vehicles by 2025 or something like that. And they are also having difficulty getting people to take on these vehicles. So I think that 2030, for California anyway, getting to 1 million vehicles, people are thinking it's going to take to, another 10 years. And then it's going to start to, gain momentum.
I believe that at the EIA conference in June, they were going to have 10 volume.
That seems highly optimistic.
Maybe have a reason to be highly optimistic. This is earlier, like yesterday, there was someone made a comment at the session in the afternoon about the need for effectively a carbon tax. It wasn't phrased as such, but something that gets rid of this piecemeal idea of cars and wind and solar as being ideological goals in and of themselves. And I think that's part of the issue with something like this, is if you did that, then it would resolve itself in a more rational way, perhaps.
And I guess I would argue on that same point, and wrote a blog about this, but again, unscientific, that when you think about how many companies use a carbon price in their FDI decision making, including the oil companies who say they don't believe in carbon prices, those companies who go nameless, you have to assume that, at least in the United States, and perhaps at some point in China soon, there's a shadow price for carbon. Once you have a shadow price for carbon, you have a shadow price for carbon. So I have really had difficulty understanding why the industry resists a carbon price, because since they're already using a carbon price to make their investment decisions, and since everybody's using a carbon price to make their investment decisions, and yet the financial community has no benefit of a carbon price, and so therefore it's just not financing anything because of the risk, you could solve the entire problem by having there be some formal channel for incorporating the shadow price into the market so that people could lend against it.
We'll make a shadow price not a price, not a shadow price.
Correct.
I would say, you can, industry aside, I'm not particularly defending, but I think it's a political issue more than anything. It's imagine a carbon tax in some form here in the U.S. Doesn't seem like it's going to fly.
So what I would tell you is, and I agree with you, that regulators have put on regulations that have created a shadow price, and so therefore there is a price on carbon from the regulations, in effect.
What is the shadow price?
So Ed is not here, but if Ed was here, he would say in the United States that the shadow price for carbon is $14 a ton. And that is consistent with roughly the level of the actual carbon price in California.
But much less than the social cost of carbon
that the administration is using, which is $37.
And certainly not hedgeable is the point, right?
Right.
You can't
Right.
trade it. So you can say that I don't dispute the finding, but ultimately it comes down to the fact that would you personally take a big slug of your own money and lend based upon a shadow price of carbon out for the next 5 or 10 years? The answer is when it push comes to shove, you wouldn't do it because you like your money and you don't like it to evaporate for reasons you didn't think of. So it has to become a transactable thing. It really does.
And how people are getting to the shadow price, there's some dispute about how you would calculate the shadow price, is the cost for each tranche of replacement that people are going to have to make in different locations to comply with the Clean Power Plan.
Even in Australia, if you think about what Chevron did to work on they spent $3 billion in carbon capture and storage because they were expecting to be price on carbon to point could argue that that's why they did that as opposed to
I don't dispute the fact that it could be a rational thing to do, but the level of uncertainty, that's kind of a big gulp moment, a white knuckle decision when you're deciding to put out that much money for something that is still ambiguous.
Well, it turned out badly because the Australians rescinded the carbon tax. Correct. And all, right, and everything we know about China, which everybody was wrong about, which I said at the beginning of the talk. So I think that's, part of the challenge, which takes us to the next question, I think. Oh, was that the last question? It gets us back to the peak demand question, right? Is that, the interesting thing to me, in light of this last conversation we just had on this question, because a year ago, I put an article out, a very speculative article out in the journal's Energy Supplement, and I was working with this group at World Economic Forum, and people were harassing me for even suggesting that there might be a possibility of peak revenue, right? Everybody disagreed. So what I think is interesting doesn't mean it's right, because we're not going to know whatever year you picked in your survey, right? But what's interesting to me is that there's very few of you said never, and I think that that's in and of itself is interesting change in attitude, in my opinion, just in 1 year. That in 1 year, it's become conceivable to people that there will be peak demand. I think it's just because we saw what happened in China. People in the audience have an opinion for what changed their mind about the concept of peak demand.
You can't hear what they talk up there.
Well, you just come on up and shout through that way.
Yeah.
There's one right there. Just
Here, I can pull this up.
that way we can share the stage. It takes the pressure off.
And Ron knows what he's talking about, so all good.
Sometimes. Part of the answer to that may be that there's been more discussion just in the last couple of years that both in North America and Europe, there has been peak oil demand, and then follow that on with what's happened in China. I think that probably leads to a greater acceptance or potential for acceptance that sort of outcome may be expected.
So I'll add to that the Chinese Academy of Social Science, I just saw a presentation where they presented their eco scenario, right? So the scenario in which the Chinese government becomes highly organized around ecological policies, so more than the IAEA, 450 scenario. And they said under that scenario that they did for the sector where the Chinese government implements all these most ambitious targets that they've suggested, that Chinese energy demand, so not even just oil demand, that Chinese energy demand would peak in that scenario in 2020. I'm happy to share the paper with you if it's of interest to people, but anyway, that was coming from a Chinese analyst. Energy consumption. That's what he said. I'll send you. I'm not saying it's what's going to happen. I'll send you the paper.
That's true.
All right, let's open up the forum for questions from our delegates. Here's the microphone.
And Schlesinger, I just want to elaborate on Ron's comment about Straubel's talk in Washington, which really was the first kind of opening, was our opening talk at the EIA conference, and it really blew a lot of people away. His point was that battery production, but there's no shortage of lithium, there's plenty. Bonneville Salt Flats, it's all going to be Western North America. The second point was that production's in its infancy, there are new factories that are going to double the global production. And then there'll be another one, and as that happens, inevitably the cost of production, technology improves with large numbers, just like shale. Our revolution came about as we were producing more and more. Our unit cost of production came down in each of the fields at different levels. So with that likely to happen with batteries, then of course there will be a lot of electric vehicles once the crossover takes place, which isn't here yet. And of course there'll be different kinds. They won't look like the electric vehicles now that go 40, 50 miles. Not hybrids.
Bring that out here, Ben.
Yeah, I'll be the microphone. He's next. Somebody else has to call on me.
Getting back to the write-downs question, do you feel that some of the oil and gas companies may have been, overzealous in their capital investments, maybe taking undue risks, or maybe risks were not properly recognized? Can you speak about that a little bit? Maybe you have already.
Who is that directed to, or all of us?
Anybody?
Yes, in a nutshell. I'll let the financial people say no, but my opinion, is that if you really had understood the cycle and you had really understood the shale, and also if you look at what the equity finance players were doing, where the equity finance players, and they may do a shift back, assets get cheap enough in the North Sea or some other place. I'm not saying equity finance won't shift offshore, right? But in the end, when prices were at $100, if you could give finance to someone who could produce the oil within a year and know you were going to get the $100, that was a much better way of betting your capital than giving somebody capital, even though the majors don't actually take capital from the market. At least they do through their stock share price. Well, I guess they don't even do that, but in the end, the market has to anticipate that. So if you're saying you're going to drill in the Arctic, especially companies, and again, that'll go nameless, that say they were going to drill in the Arctic in Russia after it was clear that we were having a war over the Ukraine, right? What were the chances that I should be giving you money to do that, and you were going to then say that you're going to be able to have the production after 10 years of work, having put your capital in a place where we're not sure what the outcome's going to be to this war over the Ukraine? I thought, to me, that looked highly risked. As a risk analyst, if somebody had come to me and said, "Do you want? If you give us $100 of your own money, we'll give you $1 million back if this project makes the IRR we're saying on our books," I would not have taken that bet for my $100, because I just didn't see how they were going to get their capital at the level that they said, the 17%. And I didn't bring my slide. I have an Accenture slide that shows you what the rate of cost overruns have been for these projects that are in the outlying areas. In the Russian Arctic, the cost overrun number is 95%, right? So in Latin America, it's more like 45%. But when you're a company, a large company, and you're doing your capital discipline, when you green-lighted that project, I don't care what you used as your clearing price, 50, 70, $80 a barrel, which was already probably too high, because you're talking about a 25-year project. You then had somewhere between a 30 and 70% cost overrun, which you didn't recognize as a risk. So, in my perspective, and I think I said it at the time, Bob's heard me say it at the time, I didn't think they were good investments. And so, of course, now that it's turned out badly, I just think I was right.
You're over time,
Oh, okay.
so this is probably the last one. Couldn't go to Mars. Maybe it's your turn.
Thank you. One thing we learned this morning from Frank Linden is that we need to be careful about exactly which risks we're talking about. And as sort of a follow-on to the question, which I'll make specific to shale. And I'll use an example of a previous set of financial events. And then I've got a question which has bothered me a long time, is if you have risks that are in different buckets, how do you put those buckets together to get an overall risk? And I think Glenn probably knows the answer to that. But we've been told that the shale patch has run something in the billions, a couple of billion of negative cash flow over the last 5 years. But when you start taking that apart, a lot of that is in maybe the lower 5 to 10% of the production mix. And a number of people have said, don't worry about the break-even costs, which I agree with. I hate break-even costs anyway. I think it's just a silly concept. But it's not going to be what's happening on the ground. It's going to be what's happening in the bank boardroom that's going to shut down some of the shale stuff. And that's why I think I disagree with my friend Amy, that I think this is different. I think the shale has added enough resources that we have thankfully finally killed peak oil, maybe for dead forever, or until we're gone. But the question about what you do about comparing, say, the events in the shale patch, I keep writing, do the name .com ring a bell? You know? Where you have enthusiastic investors chasing the next Google or Apple or whatever, in this case the next DOG or whoever else in the shale patch. It's just an exercise in Darwinism, both in the name of the company and the name of the investor. Now, if you were to have to put together the risks on the ground in terms of what was happening with drilling costs versus what kind of price looked like it was needed for successful positive cash flows against what's happening on the financial side about pulling the plug on the bottom end of the talent distribution, how do you put those things together? And I think Glenn's probably the guy, right? To answer it?
Yeah, there was a little bit of a name mix-up here. I'm Glenn, that's Michael. And so,
I was pointing at you.
okay, very good. Okay, I just want to make sure. All right,
I have a PhD from UC Santa Barbara, and I went to Cornell before that.
Oh, very well. We're practically siblings, aren't we? I don't. That's a huge question. Only a partial answer could possibly be made to it. The way I would say it is that one thing I don't like about the way you typically see decisions being made, and this is across the board, and we work in a different asset class a lot of the time, but if you see the pro formas that people put up trying to decide whether or not this project makes sense, it doesn't resonate with me because it's the standard deterministic cash flow thing. So you see all the, there's sort of arbitrary risk premium put in. I'm looking at this saying, geez, so I can't even think of the world that way. I think of the world as, you have a set of known facts right now and known costs to do something. You have a set of known market prices. And then you have, certainly in the latter, you have an idea of the probability distributions of what they might do. We have a lot of information on that. On prices, any given particular thing, you guys on the ground should have a pretty good idea of how much those can vary, and then you start making probabilistic decisions. So that's where I think that the fall down often occurs, is the concept of risk isn't even really embedded in it, other than a static, risk, a premium to LIBOR, effectively.
No, I would agree with that, and I'd say it's largely a function of the short-term thinking that markets kind of take, and creating sort of this bubble economy from asset to asset class that we've seen over the past 10, 20 years, right? To me, it's no different than that.
The egalitarian way to do that is a Monte Carlo of some kind, where you have some weighting that needs to go on with that, but that would be a way you could take very different concepts, but you have to be very precise in how you're measuring things in each of the levels.
Yeah, it's really easy to say the word Monte Carlo. It's really hard to do it right. And that's it's like giving a monkey a gun if it's just done randomly. No pun intended, actually. But the point is though that's exactly what you're talking about is a Monte Carlo view of the world. It's just that you don't want to just, like you made the point about normal distributions, nothing is, and you have to have sort of credible assessments of that. As well as Michael listed a bunch of the different risks that, banks and a lot of hedge funds think they're great at this, and they always get it wrong, is the relationship between prices as we kind of know them and default risk, which is ostensibly a price at this point. And there are just a ton of ways that people have stepped on that and done it wrong. And it's really hard to get sort of a complete, use the cliche, holistic view of the risks of even a single project. But you can start by at least trying to make bona fide random outcomes part of the analysis.